Well, interest rates have had one of their best weeks in recent memory. How far will they drop? Interest rates sitting at the lowest level they've been in the last 30 days. Mortgage News Daily tracks this daily, and they have us at 7.36 today on the national average for a 30-year fixed rate loan. 7.36. Y'all, worth remembering that 3.5 weeks ago on the 19th of October, we were sitting at 8.03. So we are down almost 3/4 of a point, a little over 5/8 of a point in rate in the last 3.5, 4 weeks, which is a tremendous reduction in rate, y'all. That is a nice trend line to establish. And we're going to dive into some of the reasons why. We have said repeatedly on this call that interest rates are going to follow inflation downward. And we got some blockbuster reports this week. Consumer Price Index came in on Tuesday, much better than expected. Producer Price Index came in on Wednesday. This is more on the wholesale side, the CPI being more on the retail side. It confirmed those CPI numbers, much better than expected. Today, we had jobless claims come in higher than forecast. All of those things are very helpful to where interest rates are and to where the future of where the Fed might take us. Those three reports, the CPI and the PPI in particular, have really reset the stage for what the markets had built in with regard to future Fed hikes and when the Fed might start reducing rates. Going into this month, prior to those reports, we were looking at a 30% chance of a hike at the January meeting with the Fed. We're now markets have now fully priced in a 2% likelihood of a cut at that meeting. So I think it's unlikely we'll see a cut at the January meeting, but again, we just removed that 30% likelihood of a hike at the January meeting. In March, the Fed was expected to have a 14% chance of a hike. That is now a 33% chance of a cut at the March meeting. At the May meeting, the markets had previously priced in a 50% chance of a cut. Everyone was kind of assuming that late spring would be when the Fed would start easing and pulling back from their current levels. There is now an 85% likelihood of a cut at that May meeting. And at the June meeting, and this has moved up from July in the prior guesstimates as to what the Fed might do, 100% chance of a cut being priced in by the market at the June Fed meeting, the June 2024 meeting. And what does all that mean to us? What it doesn't mean is that we should wait until next year to see if these cuts become reality, assuming that interest rates are going to drop further as a result of just those cuts. Now, interest rates may move lower as we continue to see inflation moderate, but when we talk about what the bond market prices in, bond prices very much follow the expectation of where those instruments are going to be trading in the future. In other words, these cuts are now priced into today's rates, which is why we've seen today's rates almost 3/4 of a point lower than they were this time 4 weeks ago. The bond market has already adjusted to the numbers I just listed. If we get to those at the January meeting, the March meeting, the May meeting, the June meeting of next year, and we don't follow suit with what the market has now priced in, then if the Fed is more aggressive in their cutting, then we will see rates improve, but the reverse is also true. If they don't cut, as these projections are now estimating or expecting, then we will see rates go back up. So that's the way to look at this, y'all. We get the benefit of a cut early when the market expects that we're going to have one. And as we have mentioned numerous times in the past, this Fed in particular has pretty much fulfilled what the market expectations are. You know, when the market says there's a 100% likelihood that we're going to have a cut in June, you can pretty much bank on the fact that the Fed will follow through on that perception unless there is some dramatic event that happens between now and then that would change their mind. So that's where we are, y'all. It's a good cycle to be in. Have we said goodbye to the eights? Maybe and probably. Again, the future is still the future and it's still an unknown. But if we continue on this pathway, we may have turned a corner that puts us on a downward glide path for interest rates. As always, hope this information is helpful for you and for your clients. If I were locking a loan and considering locking a loan or waiting until next week or the week after, I would absolutely grab these improvements now because as with all things, we see pullbacks on this. would hate to see somebody miss out on an opportunity to grab a 30-day low. So I would absolutely lock right now, grab these gains. And again, y'all, even regardless of where somebody closes a loan today, they're very likely looking at an opportunity to refinance in the next year or two. So in any event, going to continue to leave that on the table. Hope everyone stays blessed, stay safe. You've got all my contact info on the screen. Blessed to have your referrals here. Look forward to working with you soon if we haven't already. Stay blessed. We'll talk to you next week.